As we start today is still a topic which was not examined last sitting, and basically that is a topic on manufacturing accounts, manufacturing accounts. So manufacturing account. So in this case, maybe the first thing we need to ask ourselves is what is a manufacturing account? So basically, a manufacturing account, this is an account which is prepared by the manufacturing entity in order to determine the production cost, or basically the manufacturing cost which was incurred by such a company in a certain financial year. So what is a manufacturing company? A manufacturing company basically is a company which buy some raw materials and basically convert that into finished products or into finished goods, which are then sold to wholesalers, which are sold to the final consumer. So that is the first thing you need to understand, that this particular account here is basically prepared by the manufacturing entities. And actually, we are saying manufacturing entities. These are those entities or basically companies which buy some raw materials, and basically convert them into finished goods, or basically into finished what products. So mean that these particular companies here, the manufacturing companies, whatever they sell is basically what they have been able to manufacture internally. So they will buy some raw materials, they convert those particular raw materials into finished product, and basically this is now what they sell. Now, what we are saying is that at the end of the year, this particular company must prepare something called a manufacturing account. And the main objective of preparing this account is basically to determine what the production cost, or basically the manufacturing cost. So how much cost was incurred by this company in converting these particular raw materials into what? Into finished goods, or into finished what? Products. So that cost, we are referring to it as the production cost. The production cost, it can also be known as the manufacturing cost. It can also be known as the manufacturing what? Cost. And actually, in this case, we are saying for a manufacturing entity to be able to determine the production cost which was incurred in a certain financial year, so account which is called manufacturing account has to be prepared. So therefore, a manufacturing account, this one is prepared, is basically prepared to do what? To determine the production cost. The production we start today is still a topic which was not examined last sitting, and basically that is a topic on manufacturing accounts. Manufacturing accounts. So manufacturing account. So in this case, maybe the first thing we need to ask ourselves is what is a manufacturing account? So basically, a manufacturing account, this is an account which is prepared by the manufacturing entity in order to determine the production cost, or basically the manufacturing cost, which was incurred by such a company in a certain financial year. So what is a manufacturing company? A manufacturing company basically is a company which buy some raw materials and basically convert that into finished product or into finished goods, which are then sold to wholesalers, which are sold to the final consumer. So that is the first thing you need to understand, that this particular account here is basically prepared by the manufacturing entities. And actually, we are saying manufacturing entities. These are those entities or basically companies which buy some raw materials, and basically convert them into finished goods, or basically into finished products. So mean that these particular companies here, the manufacturing companies, whatever they sell is basically what they have been able to manufacture internally. So they will buy some raw materials, they convert those particular raw materials into finished product, and basically this is now what they sell. Now, what we are saying is that at the end of the year, this particular company must prepare something called a manufacturing account. And the main objective of preparing this account is basically to determine what the production cost, or basically the manufacturing cost. So how much cost was incurred by this company in converting these particular raw materials into what? Into finished goods, or into finished what? Products. So that cost, we are referring to it as the production cost. The production cost, it can also be known as the manufacturing cost. It can also be known as the manufacturing what? Cost. And actually, in this case, we are saying for a manufacturing entity to be able to determine the production cost which was incurred in a certain financial year, so account which is called manufacturing account has to be prepared. So therefore, a manufacturing account, this one is prepared, is basically prepared to do what? To determine the production cost. The production cost, or basically the manufacturing cost, which was incurred in a certain financial year, or basically which was incurred in a certain what? In a certain period. So therefore, the main objective of this particular topic here is basically to know how the manufacturing account is prepared. But it's also important for you to note that other than manufacturing entities preparing this manufacturing account, the manufacturing entities also prepare the other financial statement, the normal financial statement, which include the statement of profit or loss, and also the statement of financial position. But even before these financial statements are prepared, first of all, a manufacturing entity will have to prepare what is known as the manufacturing account. So once the manufacturing account has been prepared, then that is the only time a manufacturing entity can be able to proceed and prepare the statement of profit or loss, and also the statement of financial position. So is there any difference in terms of how we prepare the statement of profit or loss, the statement of financial position of a manufacturing entity? No much difference. There is only a slight difference when it comes to the preparation of the statement of profit or loss, specifically when computing the cost of sales. Even before you look on how we prepare the manufacturing account, when computing the cost of sales, the cost of sales of a manufacturing entity, remember generally when computing this, we take the opening stock. The opening what? Stock. In other terms, we take the opening inventory. So, but now for these manufacturing entities, usually they have 3 types of inventory. They have 3 types of inventory. We have the inventory of raw materials. We have the inventory of the finished product or the finished goods. And also we have inventory of something called the work in progress. Maybe you're going to look on what is work in progress even before you look on how the manufacturing account is prepared. So here, when computing the cost of sales, we take the opening inventory of the finished goods. And then in this case, generally, we should add the purchases. But in this case, we are saying what the manufacturing entity sell is what they manufacture internally. So what we add here is not purchases, because manufacturing entity do not buy to sell, they produce to sell. So what we add here is the cost of the goods which were produced, the cost of the goods which were produced. And actually, we can only be able to determine this cost of the goods which were produced by first of all preparing the manufacturing account. So I want us to look on how we prepare this account. But even before you do that, maybe there are some few terms we need to define here. One is there's something called the prime cost. The prime cost. What is prime cost? Basically, prime cost, this is the total direct costs which are incurred, because it is important for you to note that this particular production cost which are incurred by a manufacturing entity, this production cost can be generally classified into two. So we have the direct cost, and number two, we have the indirect cost. The indirect costs are also known as the factory overheads. They're also known as the factory overhead. So when talk about the direct cost, these are those particular costs which basically varies with the level, or basically which changes with the change in the level of production. Anytime the level of production changes, this particular cost will change. A good example is the cost of raw materials. So if the company is not producing any units, the company does not need to buy raw materials. If the company is producing 10,000 units, raw materials must be bought. If the company increases the number of units to be produced to 20,000, automatically the raw materials to be used will also do what? Increase. So the cost of raw materials is a direct cost. It always change with the change in the level of production. We also have other costs known as the direct labor cost, like the wages which are paid based on the time an employee has worked, not the salary, because salary we know they are fixed. Salaries do not change. So, but wages which are paid on the time worked, or maybe the number of units produced. So therefore, the production cost we are saying is generally classified into two: the direct cost, which are the costs which varies proportionately with the level of production, and then we have the indirect cost or the factory overhead. These are basically those particular costs which are fixed. They do not change. Even if the level of production changes, these costs do not change. A good example is something like rent. If a company is paying a rent of 2 million every month or every year, so whether the company produces or not, that rent has to be paid. So it's a fixed cost. It's an indirect cost. It is a factory overhead. So therefore, the production costs, the costs which are incurred in a production process, they are classified into two. Now, coming back to this, when talk about the prime cost basically is the total. This is the total of the direct costs. The total of the direct cost. So if you take the direct material cost, the direct labor expenses, plus any other direct expense, you get the prime cost. Then from there, we have something known as the work in progress. The work in progress. So basically, work in progress, abbreviated as WIP. This refers to those particular units which are, or maybe to those finished goods which are partially complete at the end of the year. Like, let's take a good example of a company which manufactures something like motor vehicles, or maybe a company which manufactures things like what? Motorbikes. Maybe there are those motor vehicles, there are those motorbikes which are partially complete when the year is coming to an end. Partially complete means that something needs to be done to them before they can be taken to the market. They are not partially complete. They cannot be taken to the market. So we refer to those units as work in progress. As work in what? As work in progress. Then from there we have maybe another term, and basically that is something called the unrealized profit. Unrealized profit. So when talk about the unrealized profit, generally most of the manufacturing companies may be having a policy of transferring the finished goods to the warehouse at a cost plus a certain profit. What does that mean? Generally, what we know is that if we have a manufacturing company or a manufacturing entity, this entity, once it has converted the raw materials into finished goods. So remember, this now take place in the factory. So this conversion of raw materials into finished goods take place in the factory. But these finished goods, are they kept in the warehouse? Are they kept in the factory? No. So usually they are transferred to a warehouse, and basically this whereby now they can be sold. This whereby the company can be able to do what? To go ahead and sell them. So most of the companies may be having a policy that whenever the goods are being transferred from the factory to the warehouse, they'll be transferred at a cost plus a profit. At a cost plus what? A profit. For example, maybe you can be told the company transfer the goods at a cost plus 10% what? A profit. So it basically means that this particular profit here, this one is always recognized as an income, in the income statement, or basically in the statement of profit or loss. But you can see this particular profit here was based on the goods which were manufactured and transferred to the factory. So, and therefore this particular profit can only be realized if all the goods now which will be transferred to the factory will have been sold. Because once a company transfers the goods now from the factory to the warehouse, and there is a profit which is computed on those goods, that profit can only be realized if all the goods will have been sold to its customers. But if some of the goods are not yet sold, then we have the aspect of what? Of the unreleased what? A profit. Now, having known those particular terms, I want us to move and basically we look on how do we prepare now a manufacturing account, which you have said is basically prepared to determine the production cost or the manufacturing cost. The manufacturing account. Now, when preparing this account, the first thing we do is basically to determine the prime cost. Because remember, I've said that this production cost, for this cost which was incurred in terms of producing some units, we classify that cost into two, direct and indirect. First of all, we compute the total direct cost. So we start by computing the cost of raw materials which were consumed. So here we start with the opening inventory. Of raw materials. To this we add the purchases of raw materials, the raw materials which were purchased. To this we add carriage inwards of raw materials. I hope you can be able to remember what is carried inwards. This is basically any transport cost. Maybe a manufacturing company has bought some raw materials, there is some transport cost incurred. So that is carried inwards. So, and then to this we less purchases return. These are raw materials which had been bought, but they were returned back to the suppliers due to a number of reasons. And then in this case, we get the raw materials available for use. Raw materials available for what? For use. Raw materials available for use. And then now to this, we less the crossing inventory of raw materials. So once you have deducted the crossing inventory of raw materials, we get something called the cost of the raw materials which were used, or the cost of raw materials which were consumed. So these are the raw materials which were consumed, or basically which were used during that year. So after getting that cost of raw materials, the cost of direct raw materials, to this we proceed and we add other direct expenses like the direct wages, or maybe the direct labor cost. The direct labor cost. And maybe we also add any other direct expense. A good example of the direct expense which will be given in this particular question for manufacturing companies is something called royalty. Royalty basically is a cost which is incurred by the company, or basically an amount which is paid by the company if the company, for example, is extracting some raw materials, maybe from a land owned by another person. Like maybe the raw materials used by the company maybe something like sand. So the company, or maybe that sand is is harvested from maybe the land belonging to another person. So the company agree with the owner of that land that maybe for each ton of the sand which is harvested in that land, the company will be paying a certain amount of money. You can see that sand is a raw material, but now the amount which is paid by the company depends with the number of tons which are harvested. Is a direct cost. Is a direct cost. So if you're given a royalty in this particular question for manufacturing, is a direct expense. So you add all this, and basically what we get here is now what we refer as the prime cost. The prime what? Cost. Remember, we have said that the prime cost is the total of the direct cost. So after getting the prime cost, we proceed and now we add the factory overheads. The factory overheads. Remember, I've said factory overheads in other terms. These are the indirect production cost. Indirect production cost, basically, I've said that these are the production costs which are incurred by a manufacturing entity. Basically, they do not depend with the level of production. These costs are constant. Whether the level of production changes or not, they remain the same. They remain the same. I'll just give good examples of this, like maybe the rent of the factory building, rent of factory building. We also have maybe the depreciation of a factory building, building. So we also have maybe depreciation of machinery, etc. So those are basically good examples of indirect costs which are incurred in what? In the factory. So, and then once you have gotten the total here, we proceed and we add something called the opening work in progress. The opening work in progress. And basically to this we less the closing work in what? In progress. The closing work in progress. So what do we get after doing that? So we get now something called the cost of the goods which were produced. So we get something called the cost of the goods produced. The cost of the goods produced. The cost of goods which were produced. So in other terms, whatever we are getting here, this is basically now the cost of the goods now which were produced by the company during that during that year. Is the cost of the goods which were produced by the company during that year. But remember, I say that most of the manufacturing companies may be having a policy that whenever the goods are transferred from the factory after they have been manufactured to the warehouse, they will be transferred as a profit element. So if a company has that policy, you'll always be given that information. And therefore, what you do, you compute something called the manufacturing profit. The profit which is to be recognized by the factory, we refer to that as what? The manufacturing profit. So in this case, mostly will be given this as a percentage. It should be a percentage of that. So, and then whatever you get here, we refer to this as the transfer price. The transfer price. So why are we referring to this as a transfer price? Is because this is the price at which now the goods will be transferred from the factory to where? To the warehouse. I've said this is basically what happened in a manufacturing company. Once the goods have been manufactured in the factory, they are not kept there because automatically they cannot be sold from the factory. The work of the factory is basically to manufacture, to convert raw materials into finished goods. Once they are converted, once they are finished, they'll be taken to the warehouse for them to be sold. So this is the transfer price, price. So basically this now how we do what? How we prepare the manufacturing account. The manufacturing what? Account. And basically after doing this now, I've said that a manufacturing entity then will still proceed and prepare the other final accounts. The statement of profit or loss and the statement of financial position. Is there any difference in terms of how we prepare these financial statement of a manufacturing entity with what you have been doing, no much difference. The only difference which exists is a slight difference when preparing this, which I've already mentioned, that when computing the cost of sales, here remember, you must be able to appreciate what is sold by a manufacturing entity. A manufacturing entity sells the finished goods, the finished product. So therefore, we compute the cost of sales based on the finished goods, whatever a manufacturing entity sells. So we take the opening inventory of finished goods, or finished goods, and then to this we do what? To this we add, in this case, remember I've said we don't have purchases, but to this now we add the cost of goods which were produced. But if a manufacturing entity transfers those particular goods now to the warehouse at a transfer price, that is at least cost plus a profit. So what we consider here is the transfer price. I've said it is not all companies which will be having a policy of transferring the goods from the factory to the warehouse at a cost plus the profit. So if this one we only added, I think it was important for me to note that if any. So if a company has a policy of transferring the goods from the factory to the warehouse at a profit, that's only when you add that here. But if the company does not have that policy, in fact, that should be the end of your manufacturing account. Your manufacturing account should end at that point. That's why we are saying here, if the company do not have this policy, what you consider here is this. If the goods are transferred from the factory to the warehouse at a cost plus a profit element, what you consider here is the transfer price, this one. Yes. So then to this, we basically get something called the goods available for sale. And then out to this, we less what? We less the closing inventory of what? Of still the finished goods. Of the finished what? Goods. And basically in this case now, we will be able to get something called what? The cost of sales. I think that is the only difference which we have. And actually, after getting that cost of sales, we should less it to the sales or the revenue. We get the gross profit. We check whether we have any other income. We get total incomes, and we less the normal expenses. So the expenses which we include here are the other expenses of the manufacturing entity other than what we have here. So the production cost, the costs which are incurred in the production process, they will not go to the statement of profit or loss. So actually the expenses which you include here are the administrative expenses, and maybe selling and distribution, because you can see all manufacturing expenses, all the production costs, they're included here. Yes. So that's basically how we prepare the manufacturing account. And I've said after preparing the manufacturing account, we then proceed and do what? And then prepare the statement of profit or loss and the statement of financial position in the normal way. So this is basically where we may be having a slight difference. So I'll be able to share the notes on this maybe tomorrow. Maybe someone will remind me. Is Rin in? No, can't see Rin today. Yes, maybe Benson, you can remind me to share this tomorrow. Or Peter. Yes, when getting the cost of sales, do we adjust for goods in transit? And how should we treat what? Spares, e.g. machinery spare parts, purchase and trading. Automatically those in case I've never seen a question whereby you're told there are some goods in transit. Goods in transit in relation to what? Basically, you see, whenever you sell goods to your customers, you recognize that revenue as a revenue. So therefore, whether the goods are in transit to the customers or not, you have already sold the goods to them. You recognize that as sales. You recognize that as what? As sales. How do we treat spares? Spares, machinery spare parts. I think those, in case maybe there was a spare part which was purchased, it will be towed. You'll be given that information, but in most of the cases that may be treated as part of repair and maintenance expense. Repair and maintenance expense, which I think should then be part of the factory overheads. So I want us to go straight to a question now. So let's look on a question. So I want us to start with, I think, the latest question on this. So we go to the past papers. So let's go to the question for, is it December? Yes, I want us, we do a question, at least we will be able to finish. I don't know whether we will be able to, okay. So can we go to this question here for April 2024? I think the question has both, actually the manufacturing statement of profit or loss, statement of financial position. I think the question do not have so many additional information. It's a question we should be able to finish. April 2024, which is the question number. Question number 3. Question number 3. Question number 3. Question number 3. So once you get the question, please confirm. Please confirm so that we move together. So if you're fair, yes, are you there? Are you there? Are you there? Eunice, Benson, Paul. Okay. Okay. So what are we told? What are we told here? The question is, the following trial balance was extracted from the books of 𝐎𝐍𝐿𝐍 Limited. A manufacturing company is at 31st of this March 2024. So we're given the trial balance there. And basically we have so many items there. So maybe you have ordinary share capital, revenue reserve. Revenue reserve, if you're given revenue reserve, this is another name for retained earnings or the retained profit. So then from there we have bank, we have receivables, we have payables, factory buildings, and we are told land is part of that. We have plant and machinery, motor vehicle, furniture and fittings, accumulated depreciation basically for 4 assets there. We have inventory. I've said the manufacturing companies, they have 3 items of inventory: raw materials, work in progress, and the finished product. That is something already I've mentioned. We have allowance for doubtful debts, bad debt, rent, return and insurance, direct wages, salaries, factory power, electricity, maintenance. And then we have return outwards. We have return inwards. We have advertising expenses, transport expenses, bank charges, salary expenses, purchases, and sales. Then we have additional information, number 1, all the way to note number 5. We are going to go through that as we do some workings. So what are we required to do? We are required to prepare the manufacturing account for the year which ended 31st of March 2024, 6 months. And part B, we are required to prepare the statement of profit or loss for the year which ended 31st of March 2024. And finally, we are required to prepare the statement of financial position. So I want us to go through the additional information. We see, and there are some workings we need to do. So in additional information number 1, let's go to the additional information number 1. We are told depreciation is provided using straight line basis as follows. If it is on straight line, depreciation will be computed based on cost. So we need to compute the depreciation for those, how many assets? 4 assets. So let's compute the depreciation. And basically we will start by computing depreciation on plant and machinery. So this one we are told will be 30% automatically of the cost. 30% of the cost. So then the other asset, we have motor vehicles, and the depreciation will be 25% of the cost. We will take the cost from the trial balance, and then from there we have furniture and fittings, 12.5% automatically of the cost, and then finally we have buildings, and this one will be 4% of the cost. So what I want us to do, we go back to the trial balance, we pick the cost, we take the cost of these assets. So we'll start with the cost of plant and machinery. So where do we have the cost of plant and machinery? So plant and machinery, I can see that cost below where we have the factory buildings up there. I hope you can see that. Plant and machinery, the cost is 10,920. And then for the other asset, which is motor vehicle, the cost is 71,12. The cost of furniture and fittings is 3,400. And then what is the cost of building? So the cost of buildings is basically where we have the factory buildings, just above plant and machinery. And you can see we are told the factory building is 10,500. So, and then you're told included here, because I hope you can see inside the bracket, you're told included in this cost is the value for land, is the cost for land. So 10,500, this comprises the cost of land, comprises the cost of the factory building. So what we need to do is we compute what is the cost of the building. So the cost of buildings automatically will be the difference here, which will be 6,300. So 6,300. So we need to get now these particular depreciations. So give me the first depreciation for plant and machinery. We try to hurry up so that we finish this particular question here. I try to hurry up. Yes. So what are you getting as the depreciation for? Yes, I'm told 3276. 3276. Depreciation for motor vehicles. Depreciation for motor vehicles will be how much? Depreciation for motor vehicle will be 1778. That is the figure I'm getting from Evans. So please, we try to hurry up so that we finish this particular question. Furniture and fittings. 425. And then finally, buildings 20 what? 252. Yes, 252. Okay, so we are done with that. And then you're told number 2, inventory is at 31st of March 2024 was valued as follows. So this is now the closing inventory. No working for that. We are given the closing inventory for raw material, work in progress, and the finished goods. No working for that. Number 3, we are told allowance for doubtful debts is provided at the rate of 10% of the trade receivables at the end of the year. So what we need to do here is basically we compute the allowance for doubtful debts, and basically we compare that with the amount which we have in the trial balance. So we are told this one will be 10% of the trade receivables. Trade receivables, basically, how much is that? So I hope you can see the trade receivables. Trade receivables are up there, the third item within the trial balance, the fourth item actually, which is 11,080. So this one will give us 11 what? 1108, or basically 110.8. Should be 110.8. What are you getting? What are you getting, Chris? Okay, sawa. So then what basically we need to do is we compare that with the allowance for doubtful debts which we have in the trial balance. So remember, this is the allowance for doubtful debts at the end. So we need to compare this with the allowance for doubtful debts at the start. The allowance for doubtful debts at the start is basically the amount we have in the trial balance. The amount we have in the trial balance is 588. 588. So in this case, I can see we have what? This to this. Nicole, you're saying is what? I hope the figure this one is correct. Is it correct? 1108, is it correct? Okay. So basically, I'm saying we compare this one, which is at the start, with this one. So that is an increase. From 588 to 1108 is an increase. An increase of what? An increase of what? We try to hurry up, guys, so that we finish this particular question. We can't afford to leave the question hanging. So that is 510. So remember, this particular increase in allowance for doubtful debts, this one we account for it as an expense in the statement of profit or loss. We are done with that. Then number 4, we are told electricity rates and insurance sundry expenses maintenance are to be apportioned in the ratio of 2:1 between factory and administration. So if we are told some expenses are to be apportioned, it basically means that some of the expenses belong to the factory. And any expense which relate to the factory, it should be included within the manufacturing account. It is basically one of the factory overheads. Is one of the factory what? Overheads. So all the factory overheads, all the factory expenses, we take them into account when preparing the manufacturing account. And then any administrative expense, because I've said when preparing the statement of profit or loss, we include what? We include the administration, the administrative expenses, and also the selling and distribution. Selling and distribution costs. So this one go to the statement of the profit and what? Loss. But I've said any factory overhead, or any factory expense, this one go to the manufacturing account. It's very, very important for you to know that. Sasa? Yes. So therefore, what we will be able to do, for example, when preparing the manufacturing account, we will be able to compute those particular expenses to be apportioned to the factory. When preparing the statement of profit or loss, we will be able to compute the expenses to go there. So I think we will do that when preparing the respective account. So number 5, we are told manufactured goods are transferred to the warehouse at the total factory cost. So if you're given that information, goods will be transferred from the factory to the warehouse at factory cost. There is no manufacturing profit. There is no manufacturing what? Profit. And I think having that now, we can be able to proceed and basically we prepare what is required in part A. We prepare what is required in part A. That is the manufacturing statement. Manufacturing statement. What is also known as the manufacturing account. You can just refer to it as manufacturing account. Yes, and this is for the year which ended 31st of March 2024. 31st of March 2024. So for you to be able to prepare this account, what is just required is just to remember the format. If you can be able to remember the format, then to prepare this one is very, very simple. So I want you to have that title because I want us to do this in less than 10 minutes because now we have all the items, just the format we need to remember. Okay, so we go straight to this. Remember, in our case, we need to have basically how many columns? We need to have 2 columns here. 2 columns. And I hope you can see also our figures are in thousands of shillings. And in thousands of shillings. So here we start by taking the opening inventory of what? The opening inventory of raw materials. So it is important for you to note that when preparing the manufacturing account, we first of all compute the cost of raw materials which were consumed. Yes. So what is the opening inventory of the raw materials? That one is within the trial balance. Within the trial balance below where we have the accumulated depreciations and the inventory, the opening inventory of raw materials is 2870. So to this, what do we need to add? We need to add purchases and basically the purchases of raw materials. Where do we have the purchases of raw materials? The last item within the trial balance. The last item within the trial balance. We are given purchases and sales. So no need to think what is sales and what is purchases. Purchases is an expense. It should be on the debit column. So in other terms, those figures, they follow one another the way the words are arranged. Purchases come first, the sales should be on the other side. So the purchases of raw materials, therefore, is 77,000. So to this, then we have said we add the carriage inwards. And I think in this particular question, do we have carriage inwards? Do we have carriage inwards? Can you see carriage inwards somewhere? I can't see any carriage inwards. I can't see any carriage inwards. Any carriage inwards. I can't see any. Yes. And then now to this, we less the return outwards, or basically the purchases return. The purchases return outwards, or basically the purchases return. Purchases return, and I think we have that. We have a return outwards. I hope you can see that figure down there over 266. Anything to be deducted, we said should always be inside there in the bracket. And then what we will be able to get here are the raw materials available for use. Raw materials available for what? For use. Give me that figure. We try to hurry up because of time. Raw materials available for use. Raw materials available for use. We try to hurry up, please, because of time. 79. 79,604. Yes. And then out to this, what do? We less the closing inventory of the raw materials. Now, the closing inventory, this one is always part of the additional information. Part of the additional information number 2, in note number 2, we have the inventory at the end of the year of raw materials, and that one is given as 11,690. It is also important to note that our figures here are in thousands. When taking any figure from the additional information, we must omit the last 3 zeros. Yes, that's why you can see we are not taking the full amount. Then here we will get the cost of the raw materials which were consumed, or basically the cost of the raw materials which were used. So this will give us what? This will give us what? 67,914. Yes. So that is the cost of the raw materials which were consumed. And then I've said to this, we should proceed and we add the other direct cost, the other direct manufacturing cost. Things like maybe the direct labor cost, the direct wages. I think in our case, I saw direct wages. Yes, there is somewhere we're given the direct wages there. The direct wages. So we add it here. The direct wages, which is basically below the rent and insurance, and that is an amount of 6440. And then now to this, we should also add any other direct cost which is incurred in the factory, e.g. what? Royalties. E.g. royalties. And I think in our case, we don't have any other direct cost. Any other direct cost. I don't think so. I don't think we have any other direct cost. Other than what? Other than the direct wages. Okay, yes. So basically what we need to do, we need to get the total here, which now will be known as the prime cost. Prime cost. Prime cost is the total direct cost. Prime cost. And that will be what? That will be 74. 74.3. No, those are not direct expenses, Paul. They are indirect costs. They are indirect costs. Sasa, yes, that's basically what we are adding here. After that, factory power. This is not this is not a direct expense. So anytime there is a direct expense, will be given. Direct expenses include things like direct wages, or even direct labor costs, or royalty. Any other, like the one which I'm told there by Peter, factory power, that is basically indirect factory cost, or basically factory overheads. Yes. So what we need to do here is we proceed and we add the factory overheads. Make sure you write that in full, or the indirect cost. The indirect what? The indirect cost. The indirect cost. You see, something like factory power. Factory power is something like maybe electricity. So electricity, basically, we know is not 100% direct cost. So if the company is not producing, company will have to pay some electricity. Some of the electricity is fixed. NASA is not a direct cost. So those costs which are pure direct are things like wages. You only engage workers to work in the factory. Whenever you are producing, you pay them based on the hours they have worked there. You only buy raw materials whenever you are producing. So all those are direct costs. But electricity you have to pay whether you're producing or not. Rent you have to pay whether you're producing or not. Your asset will have to depreciate whether you are producing or not. Those are indirect production costs. So the indirect or the factory overheads, which I want us to include here first of all, is maybe from note number 1. From note number 1, we need to ask here which asset here, which are used in the factory, because you need to know the asset. You can see the examiner, for example, he has not will not tell you which assets are used in the factory, which assets are used for administration. But basically, we know plant and machinery. Are these assets used in the factory, or they are for administration? Tell me. F for factory, A for administration. Where do we use machines? Machines are used in the factory. Machines are used in what? In the factory. That's the position. Units, where do we use the machines? Machines in cocoa factories, so their depreciation will not be taught by the examiner as a factory overhead. So we have depreciation on plant and machinery. And maybe you can record those in the first column here. 3276. So what about motor vehicles? Motor vehicles, is there any information we are given about motor vehicles? So some of the assets you may be told by the examiner. Like in this case, you can be told a motor vehicle is a delivery van. So if it is a delivery van, it's basically for delivering goods to customers. So that one, that depreciation should be a selling and distribution. But in this case, you can see, take into account the question is silent. In this case, we will treat that as administration expense. So we treat it as administration what? Expense, because we know a motor vehicle will not be used in the factory. We use a motor vehicle within the factory, unless maybe you're told there are those tractors for off-roading and maybe roading. Yes, but in this case, you're given a motor vehicle, the question is silent, treat that as part of what? As part of selling and distribution. So then we also have furniture and fittings. Furniture and fittings, they are not used in the factory. They are used in the office. But now this factory, this building, if you can be able to recall, we are told is a factory building. Factory building, these are factory building. So its depreciation should be part of the factory overheads. Depreciation on factory building, this one, which is 252. Yes, then we are in the additional information. I want us to go to note number 4. In note number 4, we are told there are those particular expenses which are to be shared. Basically, to apportion an expense is to share. There are those expenses which will be shared between administration, between the office and factory. One of it is electricity. The other one is the rates and insurance. And also we have the salary expenses. Salary expenses and basically maintenance. So we take these particular expenses and basically we take the amount to be apportioned to factory, the amount to be shared by factory. So let's first of all we take the expenses, but even before we take the expenses, we are told that these particular expenses will be apportioned or will be apportioned in the ratio of 2:1, between factory and administration. So the factory here will get a share of 2 out of the total, out of 3. So that is the factory share. 2 all over 3 times the expense. 2 all over 3 times the expense. 2 all over 3 times what? The expense. So let's now take the expenses. We will start with electricity, which is within the trial balance. And I think I can see that below factory power. That is 1386. And then we have rates and insurance, which is 798. And then we have salary expenses. Salary expenses, where do we have this? So we have this as the second item from the bottom of the trial balance, 2436. And then we have maintenance. Maintenance is below electricity, which is 924. So let's work out these figures. So we start with electricity. We get 2/3 of 1386. Yes, so get 2/3. Okay. Yes, I think I have a calculator here. 2/3, I'm told by Paul, is 924. 924, please confirm that. The other one I'm getting 532. 532. The other one 2 all over 3 times 24, 36, which is the 1624. And then the other one is 924 times 2 divided by 3. which is 616. 616. I hope that is what you're getting. Yes. So we are done with that. So we need to move to, yes, I think basically we are done with the addition information. So what we need to do is we go back to the trial balance. We pick now the other expenses which are factory related expense. Factory related expense. Maybe you can start from the last item within the trial balance. We have purchases. It's not an expense. We have dealt with salary expenses. Bank charges. Bank charges is not a factory related expense. This is administrative expense. Transport. This basically transport expenses is also administrative, or maybe selling and distribution. It cannot be a factory, because factory we can only have carriage inwards of raw materials, which you already considered up here. Advertising is a selling and distribution. You advertise in order to sell. This is not a factory expense. Return inwards, that one will be deducted from the sales. Return outwards, we have dealt with that. Maintenance, we have dealt with that here. Electricity, we have dealt with that. And then we have the factory power. Factory power is basically a factory overhead. A factory power, which is 1890. And then above that, we have salaries. Salaries, were these to be apportioned? No. So, but in this case, salaries, if the question is identity is administration, because in factory, what is paid are wages. Wages are like salaries, but wages are paid based on the time you work. Sasa, yes. So then above that, we have direct wages. We have dealt with that. Rent and rent and insurance. We have dealt with that. Budget. This is a selling and distribution. So, and then we have allowance, which is still a selling and distribution. Then we have inventory accumulated. After, I think we have the asset only. So we don't have any other expense here or any other factory overhead. So what we need to do is we basically get the total, and we take that now to the last column. So let's get the total here. 3276 plus 252 plus 924 plus 532 plus 1624 plus 616 plus 1890. So I'm getting a figure of 9114. Confirm whether that is the figure you're getting. Yes. So we added to this. We added to that. That is 74,354. And I'm getting 468. So confirm whether that is the figure you're getting. Confirm whether that is the figure you're getting. Is that the figure you're getting? Okay, sawa. So then to this, we have said we proceed, and basically we do what? We add opening work in progress. We add opening work in progress. Opening work in progress. So we add this, and basically we less the closing work in progress. Yes. So, and in our case, we have this work in progress. The opening work in progress is within the trial balance. So can we go back to the trial balance? The opening work in progress is given as 4830, and then the closing work in progress is given within note number 2. Within note number 2 is given as 6930. So, and then now to this, we will get the cost of the goods produced, the cost of goods produced, cost of goods produced. So give me the final figure here. So we take this one, we add 4830 minus 6930. Yes, so basically that's the figure I'm getting. I don't know whether that is the same figure you're getting. Yes. Basically, that is it. That what is required as far as the preparation of the manufacturing account is concerned. And the marks are located there were 6. Automatically, these are the items which are marked here. These are the items which are marked. And basically, by doing that, you get 6 marks. So let's move to part B. And basically, we are required to prepare the statement of profit or what? Or loss. Basically, for the year which ended 31st of March 2024. 31st of March 2024. Basically, I've said there is no much difference in terms of how we prepare this. So to prepare the statement of profit or loss, it all depends on whether this business is a company, whether it is a partnership, whether it is a sole proprietorship, because it is also important for you to note that a manufacturing business may be conducted as a company, may be conducted as partnership, may be conducted as what? Sole proprietorship. But I think this is a company. So this being a company, I don't think we have much challenge in terms of how we prepare this. So we will start with the sales. But remember here, we need to have 2 columns. We need to have 2 columns. I hope you can be able to see that far ahead. Yes. So we start with the sales. And basically, sales is given as the last item within the trial balance. Sales as an amount of 103,600. Sales should be on the credit side of the trial balance because it's an income. So to this, we less the return inwards. The return inwards. So the return inwards, I can see that within the trial balance, there's a figure of 84. So we less it there. And basically, we get the net sales. We get the figure for net sales. Net sales will be how much? Net sales will be how much? Will be 103. 103, 5 what? 516. Yes. So then to this we proceed. We compute the cost of sales. So the cost of sales, we start with the opening inventory of what? Of the finished goods. So it is important to note that here we use the finished goods. You can write that in full for your revision purpose. Opening inventory of finished goods. So we have this within the trial balance, the opening inventory of finished goods, which is given as 91. And then I've said that here we don't add purchases because generally we have been, all through we have been adding purchases. So here we don't add purchases. We have said manufacturing companies sell what they produce. They don't buy to sell. They produce to sell. So what we add here is the cost of the goods which were produced. The cost of the goods which were produced. So this is the cost of the goods which were produced. 81,368. That is now what they produced. And equally in this case here, we don't have return inwards. We don't have carriage inwards. So, and that's what you can see. Anytime you're given carriage inwards, you're given a return outward. The examiner will not even tell you that is carriage inwards or the return inwards for what, but automatically that is carriage inwards, return outwards for raw materials. That's for raw materials. Because what we sell here is what we produce. We can't have a return inwards of whatever you produce. We can't have carriage inwards for whatever we produce. So we add these 2 figures and we get the goods available for sale. And then to this, we less the closing inventory still of what? Finished goods. Still of finished goods. So first of all, give me the goods available for sale. the goods available for sale. We add these two values. So this will give us 468 and then 0, 90, 468. Then we less the closing inventory. The closing inventory of finished goods, this one is given in note number 2. In note number 2, 8680. 8680. So you're getting what? Is the goods available for sale? 81788. What are you getting? I'm waiting for the answer here. Yes, so we now get the gross profit. I think that figure is confirmed. I hope the figure I'm given by Evans is the gross profit, 21, 21,728. 21,7, okay, yes, thank you. So then to this, what do? We check whether we have any other income. Remember, I've said there is no difference in terms of how we prepare this one. So the only difference is here. Sasa, but the other parts are the same with what you have been doing. So what we need to do is basically we go back to the trial balance, and on the credit side, we check whether we have any other income like investment income, discount received, and so on. I think the items on the credit side up there, I can see ordinary share capital, revenue reserve. Revenue reserve, I've said, is another name for retained earnings. Never make a mistake of treating that as what? As an income. Down here, I can see we have payables, accumulated depreciations, allowance. I'm checking the items on the credit side and then return outwards. And then we have sales down there. So it basically means that in our case, we don't have any other income. So what we need to do is basically we proceed and we less now the expenses. We less the expenses. Now for the expenses, we can start with the additional information. Let's start with the additional information. We will start with the additional information number 1, where we computed the depreciation. And I think we said that this will be a factory of it. Any expense which you have included here, don't take it to the statement of profit or loss. Any expense included here is a factory expense. What we take here, I think I've already mentioned some, are selling and distribution and administrative expenses. Sasa, yes. So this one you have already recorded here is a factory of it. Then we have this depreciation on motor vehicle. Depreciation of motor vehicles, which is 1778. Then we also have this depreciation on furniture and fittings, which is 425. Remember, this one is a factory overhead. So we are done with that. So then from there we have note number 2. We have that is all about the closing inventory. Note number 3, we have the allowance for doubtful debts, and basically we determine the increase here. So this one is supposed to be included here. Increase in allowance for doubtful debts, which is 520, like that. So then from there we have note number 4. Note number 4, we have these particular expenses which were to be apportioned. These ones. So remember, the factory is getting a share of 2/3. So administration will get a share of a third. We'll get a share of a third. So I think basically we can take what we have here. We start with electricity. Administration, we will take a third of this, 1386. I hope you can be able to see down there. Okay, so we need to create some space up here so we can do away with this. So we can create a space here. I hope you already have this with you. Let me do away with this one. Okay. So we have electricity, we have rates and insurance. Rates and insurance, which is basically a third of what? A third of 798. And then we have salary expenses. Salary expenses, we take a third of this, 24, that is 6. And then we have the maintenance. Maintenance, basically a third of this one, 924. So let's compute those final figures. We start with electricity. We just take 1386 divided by 3, which will give us 462. And then we have rates on insurance. We have 798 divided by 3, which is 266. And then we have salary expenses, 24, that is 6, divided by 3, which is 812. And then maintenance, we have 924 divided by 3, which is 3 what? 308. I hope those are the figures you're getting. Are you getting those figures? Are you getting those figures? If yes, please confirm. Okay, that is confirmed by Evans. So we are done with the note number 4 and equal note number 5. So what we need to do is basically go back to the trial balance. We see we've dealt with all the selling and distribution and also the administrative expenses. Yes. So what we have there in note number, okay, the first, maybe you can start from the last item within the trial balance. We have purchases and sales. We have dealt with that. Salary expenses, we have dealt with that. We have dealt with the, okay, we have bank charges now. The bank charges. So bank charges basically is an amount of 238. So then above that, we have transport expenses, which we said is also supposed to be considered here. Transport expenses. Transport expenses, 1946. Then we also have advertising. Advertising expenses, 728. Then we have the return. Up there we have maintenance, electricity, we have dealt with that. Then we have factory power, we dealt with that as a factory overheads. And then I think we also have salaries. Have we considered that here? No. Salaries. So basically salaries is an amount of 7560. 7560. We have direct wages, which is was part of the prime cost. Rent and maintenance, we have dealt with that. And then we have the bad debts. The bad debts, basically, which amount to 406. So up there we have inventory. Yes, and I think basically we are done. We don't have any other expense. So what we need to do is we get the total expenses. So let's get the total expenses here. Starting from where we have the depreciation of motor vehicle, 1778 plus 425 plus 520 plus 1520 plus 462 plus 266 plus 812 plus 308 plus 238 plus 1946 plus 728 plus 7560 plus 406. So basically I'm getting 16,969. So can you confirm whether you're getting that value? Are you getting that value? Are you getting that value? I'm waiting for the confirmation. If you're getting a different value, type it there. If you have a different value, if you have a different value, type it there. Eunice is getting a different value. 1549. 15. Okay, so it basically means that my figure is wrong. So then we should work with that one. 154449. Okay, yes. So we less that now from this one. And basically we get what? We get the profit before tax. Remember, this is basically a company. The profit before tax will be how much? 21,728 minus 15,449. So which is 62.79. 62.79. Okay. So then to this we should less the corporation tax. The corporation tax. And I think if you check on this particular question, we are not given tax. So if you're not given tax, we ignore that. So if the question is silent about tax, just ignore that. And then whatever you get here should be the profit for the year, because equally we don't even have anything to do with the dividends. So to this profit for the year, would we add? To this we add the retained profit balance brought down. The retained profit balance brought down. This, remember, is what you're given in the trial balance as the second item, and basically known as the revenue reserve. I've said if you're given revenue reserve, that is another name for retained profit or the retained what? Earnings, which is 10,150. And basically we are done with that. We get the retained profit balance carried down, which now would be 9,2,4,16. 16. And basically remember, this is the value which we take to the statement of financial position as a component of equity. So we are done. We are done with that. So the marks allocated there were 8. Automatically, those are the items which will be marked here. These are the items which are marked there, which are marked. And basically, by getting that, you get how many marks were there? Are they? How many were they? There were 8. There were 8. So then I want us to finalize by preparing what is required in Part C, the statement of financial position, statement of financial position as at 31st of March 2024. 31st of March 2024. Yes, so here we just need to have a single column. And we will start with the non-current assets. We will start by recording the non-current assets. So basically we have a number of non-current assets. A number of non-current assets. So let's start with which non-current asset. We start with the factory buildings. We start with the factory buildings. So what we will do, we will take the cost, and we will take the cost of 10.5, which include the cost of land. Don't separate that. So factory building, this cost comprises the cost of land. Now to this, we said we should less two depreciations. Depreciation at the start and the depreciation for the current year. Depreciation at the start is what you're given within the trial balance. Within the trial balance, I hope you can see the accumulated depreciation at the start, 1250. And then to this, we also less the depreciation for the current year, this one, 276. So we will come back and basically compute this one. And then we need, below that, we have what? We have plant and machinery. Plant and machinery, we do the same. We take the cost at the start, which is basically 10, 920, minus accumulated depreciation at the start, which is basically within the trial balance, and that is 2562. And then the depreciation, is that correct? Plant and machinery, the cost is 10, 920. Accumulated depreciation at the start is not this one. This one should be 3958. 3958. And then we less the depreciation for the current year. Oh, sorry. Even this one is correct, is not correct. The depreciation for building for the current is this one, 252. 252, Yes. Then plant and machinery, the accumulated depreciation at the start, I've said, is 3958. And for the current year is this one, 3278. 3278. Yes. So then from there, we have the other asset, which is basically motor vehicle. Motor vehicle, I will take the cost, which is basically 7112. I will less the accumulated depreciation at the start, which is within the trial balance, and that is 2562. 2562, and then the depreciation for the current year, 1778. So then we also have the furniture and fittings, the cost, 34. The accumulated depreciation at the start within the trial balance is 2562. Oops, no, is what? Is 980. And then the depreciation for the current year, which is 425. 425. I hope all those figures are correct. So what I want us to do is basically we compute the net book values at the end. So let's start with the factory building. Or is there anyone who has managed to compute those values? Maybe you can give me for factory building. So if you have managed to compute those figures, type them. Type them there. Okay. So I'm given those figures by Evans. Yes, like that. Like that. No need of computing them so that we save time. Yes. So after this, basically we need to check whether we have any other an item of non-current assets. And I don't think we have. I don't think we have any other item of non-current assets. So I think we can move now and we record a current asset. So let's move and record current assets. So current assets. So for the current asset, basically we have a number of them. We have a number of item of current assets. So maybe starting from where we have, and remember all assets have a debit balance. We check the items appearing on the debit side. So the first item is the bank. The bank is 85.92. Then below that, I can see we have the trade receivables. Trade receivables, we will take 11,080. And then remember to this, we have around for doubtful debts at the end of the year, this one, which should also be deducted here. Which should also be deducted here. Maybe you can just give me the final figures here. The final figure, give me the final figure here. The final figure is 99.72. 99.72. 99.72. Is that what you're getting? Is that what you're getting? Okay. So then we still check the other, whether we have any other item of current assets on the debit column. So down there, you can see we have opening inventories. So we don't record opening inventories here. Then you can see we have bad debt rates, direct salaries. I think all those are items of expenses, actually up to the last item. But now in the additional information number 2, we have the closing inventory. Additional information number 2. So the closing inventory, we have closing inventory for raw materials, closing inventory for work in progress, and closing inventory for finished goods. So I've said manufacturing companies have or basically inventory comprises of 3 items. These 3 items. So raw materials 11,690, and then we have that is 11,690, then 6930, and then 86 what? 8680. So then we are done with the point number 3, 4, 5. Yes. So in our case, I don't think we have any other item of current asset. So what we need to do is to get the total assets. Give me the total assets. So add all those values. So if you have the total, type it here. Yes, what are you getting? Yes. So next we proceed, and basically we record equity. Equity. So equity comprises of the share capital and reserves. Equity comprises of the share capital and reserves. Share capital and reserves. So we start with the first item within the trial balance, which is basically ordinary share capital. Share capital. So the ordinary share capital is 42,000. So then from there we have the revenue reserve. The revenue reserve, I've said, that is another name for retained earnings, or basically the retained profit. And basically that is the revenue reserve at the start, the retained earnings at the start. Is that what we record here? No, whatever we record here is this one, the retained profit at the end of the year, which is 16,429. Then I don't think we have any other component of equity. You can check the items of the credit side, which we don't have any other item of equity. So we just get the total equity. The total equity, which will be 429, and then this one will be 58. Then from there we proceed, we record liabilities. We start with non-current liabilities. Now, for the non-current liabilities, in case of a company, we say that this may take the form of a bank loan, may take the form of debentures. So in this case, we don't have debentures, we don't have a bank loan. Sasa, yes, my camera is almost going off. We need to finish on this. And finally, we need to record what? The current liabilities. So current liabilities, we check the items on the credit side of the trial balance, the items on the credit side of the trial balance. Other than what we have up there, share capital and reserves, I can see we have trade payables. We have the trade payables. The trade payables is an amount of 48.86. Then down here, you can see we have accumulated depreciations. And then down here, you can see we have allowance for doubtful debts and then allowance. And then in the additional information, we don't have any item of current liability. So I think we are done. We are done. We are done. So we get the total equity and what? Liabilities. So you add these two. You add those two. They should give us 63,315. 63,315. Is that what you're getting? Is that what you're getting? Please confirm. My camera is almost going off here. Yes, I'm told 63,315. So basically that is it, that what was required. And basically by doing that, the marks allocated here were 6. The marks allocated there were 6. So basically what you'll do, you'll attempt another question, because there are so many questions from the past papers on this. And then once we are done with the syllabus, we will be able to come back to this topic and maybe you do another one question or maybe two in course of our revision. Once we meet in our next class, we basically move to another topic. We move to another topic. I think there is a topic which is remaining on manufacturing. Not manufacturing, accounting for non-profit making organizations. I think that should be the main topic, and then another topic for Elas, and then now other small topics, other small what topics. So we're almost done now. We're almost done with the syllabus. Right now, I can say we're almost like, can I say over 90%? Over 90 or basically over 95% done with the syllabus. I think we should be at that stage of completion. So we continue from there in our next class. But I've said, go through those particular past papers. We'll be able to see that there are so many questions coming from this topic. Sasa, we stop at that point for now. Have a good night. We continue from there in our next session. Have a good night. That was question number 2. So if you're there, please confirm. Yes, are you there? Do you have the question with you? If yes, please confirm. Please confirm, please confirm. I can see we have 1 hour, 20 minutes. We must finish this particular question here. We must finish that question. Okay, so what are we told? What are we told? That is the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝑠𝑠 Limited, a public limited entity, public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝑠𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝑠𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝑠𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent, and then Paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝑠𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝑠𝑠 for an immediate cash payment of 15. So this company here, we are told, acquired 50% shareholding in a company which is called 𝐎𝐍𝐋𝐈𝐍𝐄 Limited, 𝐎𝐍𝐋 Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of a financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax and other comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount, with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐎𝐍𝐋. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which we are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount, with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value, with an amount of 560 million. So because this revaluation. Okay, this 561 we are saying this is a revaluation gain. This is a revaluation gain by paper. Did the paper limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number two, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There's a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April, 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful life. And I hope you can see that within note 1. Can you see the remaining useful life? How many years? In note 1, remaining useful life. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful life of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that The subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2. The revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told Lock Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Lock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Lock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Lock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here would be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in sisters were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill the goodwill on acquisition of this company, that is Paper, Paper Limited, Paper Limited, as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in 2 forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, and as a non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 31 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and LOC limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here: 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values, so that then we proceed and we less the net assets, which one acquired. And basically, I'm told that this one will give us 4360, 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, these are the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. the consolidated statement of profit or loss, which is for the year which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51 what? 80. So remember, we are not consolidating their joint venture. So then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. The final value I'm given 85. I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what do we need to do? Can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year ended on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October, 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in CSAS, which is 50%. That gives us now the group share of CSAS limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 marks. No single question for group accounts will come across whereby the distribution cost is to be adjusted. These always have 3 marks. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that we understand amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. We did come to 121. Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid or the cost of investment. That is basically what we have within the statement of financial or within the statement of financial position of the parent and the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year. Sisters was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here. 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we say should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute in an exam. They will consume a lot of your time, and you end up maybe getting that figure wrong. So, but we'll come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is log, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we're given the retained earnings of log, that 380. For paper, it is given as what? 1,800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. Is to less the pre-what? Acquisition. That does not apply to the parent. It only applies to these two companies. That's yes. And I think for this, what we will do, for this company, I think we computed the, for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in the tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 all over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track variable, what do we get here? We get what? 5 what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this unreleased profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have unreleased profit that will also be deducted from the retained earnings of paper, 50, like that, like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures. That is 380. This one 2400. This is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent, we take 100. For paper, we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 38.60, which basically give us 93.60. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now to compute this, very simple. We take the NCI at fair value. The NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share law, the post, that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary. Which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we less here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No item to be deducted there. So we add these two values and they give us 9 what? 940. So the NCI fair value here is basically 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this. Because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. 10 bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be, is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is there. What is the difference? Is the difference, is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 92, 70. And the retained earnings should be 30, 37, 50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here. Because remember, these are an expense which the parent company was supposed to have accounted for. The parent company needed to recognize this as an expense. And that's why you can see in the income statement, the parent company didn't have a finance cost. That was supposed to be captured here. And therefore, even the profit which you have taken into account here, that was supposed to have been deducted. And because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account. In relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it. Because now what I want us to do once we meet in our next class, we are looking now on special cases in group accounts. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories and maybe like the financial statements of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week. But one on Tuesday. On what Tuesday? So let's stop at that point for today. You have a nice weekend and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday.